Testing. Welcome, everybody. Did everybody hear me okay? Well, I know everyone in the room, but I'm Brian Puckett, and I tell you, I am just humbled and delighted that all you guys are here today. Dennis is going to talk about some of the milestones that we've experienced at our firm, but it's all about you guys. I mean, we have the best clients that anyone could hope for. You guys sort of know the drill. We try to keep this a little bit casual. If you want something else to eat or want something else to drink, just get up, make yourself comfortable. You need to use the restroom, they're right off the lobby. As far as time, we're going to try to keep our remarks right around an hour as usual. Today's going to be a little bit different. First of all, you may have noticed, we didn't start late today. We're starting early, believe it or not. Doesn't happen very often. Okay, so really important. I know you guys love these legal disclosures, so please pick these up. Read them at least twice when you get home tonight. Debbie's got a copy for each one of you. But we have probably the best part about today is that you're not going to need to listen to me talk for a whole hour. We've got a really special speaker with us today, Mr. Scott Bosworth, who came all the way from Austin, Texas. I think you're really going to enjoy some of his comments. And so with that, Dennis, you want to kind of fill the crowd in on stuff that's been going on at Align Wealth Management?
All right, quick update on the team. We currently serve 200 families, and we recently crossed the $300 million in assets under management mark just last week. Thank you. And I've been in business over 25 years now, so time's flying, as we all know.
Makes Fred Beninati and Gary and Diane Brown feel a little old. Or do you know how little I knew back then?
That's funny. Quite a few of you have asked, and so we're excited to announce that we did win the Reader's Choice for the 6th time this year. So thank you for taking the time to go vote for us. We really appreciate that. It means a lot to us that we know you're all busy, and we really appreciate you going and doing that. So you might have seen if you paid on the website and Facebook, things like that, we've received a few accolades lately. We know that's because of you. So we appreciate you guys, and please know that we won't forget that. No, we won't forget that the reason we're getting this is you. It's kind of funny because the last 2-3 years we really haven't done any marketing. We've really focused on just doing the best job we can for you guys, improving our service and controlling the growth of the firm and limiting it, how many families we bring on each year. We recently, this year, we upped the minimum for new clients to come on board to $750,000. So we really want to control how many we bring on. But let me kind of remind you, if you have a friend or a family member or something you care about, that really doesn't apply. That's part of the service we offer you guys is you can send whoever over, no matter how much or how little they have. We're here to help you and the people you care about. So please don't worry about the minimums or anything like that.
Let me just go over the agenda, but then I want to speak to a little bit about what Dennis just said. But so today's agenda is going to be much more fun, I think, than the last time we were together. You maybe remember the last time we were together in this room. I mean, we were going over, okay, we're going to do this portfolio refinement, and then here's all this heavy data and lots of math, and we're going to make this other tweak, and here's all this data. So today, not only are you going to listen to somebody that's so much easier to listen to than me, but it's going to be more big picture, and I think it's going to be more enjoyable. And then, of course, before we adjourn, we'll answer any questions that you guys have. A lot of people that are in our business establish asset minimums, and the reason that we did that is, and it's very interesting. We had a new family we brought on board. I can't remember, within the past couple of months. And he was pretty astute in his questions. He's like, okay, so tell us how many clients you have, and he really wanted to get to how he's going to get good service. And so, like Dennis said, we did raise our new relationship minimum, but it doesn't affect anyone in this room. Everyone in this room has been with us. I don't care how much money you have or how much money you don't have. you're part of our tribe. And, you know, anyone that you care about, whether it's a friend or a kid or a grandkid, we will help them in any way. This is all about maintaining our...
They don't have to become a client.
Yeah, and they don't have to become a client. I just wanted, when Dennis articulated all these awards and all that, I mean, we know that we win those things, we get that recognition because we have the best clients. And I just want you guys to know that it's not about, you know, we're uppity and all that, so we're raising our minimums to $750,000 or $1 million. It's all about really not growing too fast so that we can't give the great service that we really pride ourselves on. So I just wanted to make that point to you guys that we're there for you no matter what asset level you're at, and for people you care about no matter what, and whether they become a client or not. So I just wanted to make that point. So today's agenda, we're going to go over a little bit about what's happened in the markets this year, what our portfolios have done. Then Scott Bosworth is going to come up and talk with us a little bit about investor psychology. I think you'll find his thoughts. Every time I listen to Scott, I learn something, and he's easy to listen to. So I think you're really going to enjoy that. And then we'll conclude with a Q&A if you guys have any. So briefly, the last time we were in this room, these were the kind of returns that we were looking at. And as I brought just so that was then, this is now. I was listening to a song recently, and it says, "Don't fall in love with the way things were," because it's, and I'll quote what we said about there. If there's one thing that we must all recognize about 2017 is investing rarely gets this good or this smooth or this easy. I mean, we could do no wrong. You could basically be a dunce and make a lot of money in 2017. This year, things have changed. So this year, we welcome back to normalcy and volatility, and things are kind of go up and down and up and down. And last year we saw things like in international and emerging markets did somewhere between 25% and 38%. So it really is not that big a surprise. I know it's no fun. I know it's no fun to go 6 months without making any money, but for stocks to take a breather after giving us 20, 30, and 40%, it's not such a surprise, really. So this is sort of the way things are. I know it's probably not what you want to hear, but one of the things you've noticed is we try to tell it like it is and tell people the way things are and the way things are likely to work. This is the way capital markets work. And this is why we get rewarded with premium returns over time, because sometimes we've got to go through, a little bit of not so fun times. And so.
All right, I know this chart's busy. I'll change it here in a minute, but just an update as of June 30th. So now we have over 19 and a half years of returns on our 4 most popular portfolios. That's what you see here. For those of you who are in, the most conservative one is 40% stocks up to 100% stocks. But I want to blow up the last and the first columns here and just kind of give you an idea of where we are. So the more meaningful ones to the right, see these are our returns for these, for our 4 most popular portfolios. A lot of you are, maybe not 40% stocks, 45 or 50 or somewhere in between based upon your customized plan. But what you see here is our most conservative one up top, 40% stocks, 60% bonds. Since 1999, it's averaged 6.1% annually. And if you go down to the benchmark, that's exactly what the S&P 500 done in the same period of time. So with about 60% less risk, we've been able to match what the S&P 500 has done each year on average. And then you get to the equity portfolio, it's at 8.4. And again, we're, our investment philosophy. We're not trying to beat the market. We're not out picking investments trying to beat the market. We're just diversified, trying to get market returns, paying attention to your portfolios every single day, rebalance when needed, control what we can't control. But by not trying to beat the market, we beat the market. Oddly enough. And so you see we did 8.4%, where the S&P 500 did 6 and the international did 4. So more short-term, less meaningful year to date, you see they're all about flat. So you've seen that in your performance reports. And so the question is, should we be concerned about these returns being flat year to date? So the answer is no. You've seen this chart before. when we've done these, so I just wanted to show you the updated version of it. This is the S&P 500s over the past 38 years. And the brown numbers, which are pretty small, but I'll tell you a few of them, is the average or the entry year decline each year. And the gray bar is where it finished. And so if you look back over this 38-year period, the average entry year decline, so every year on average, the S&P 500 falls 14% on average. But 29 of the 38 years, it ended up positive, even though it had that. And so as Brian said, last year was not the norm at all. We're back into the normal market this year. If you look at last year, it only declined 3% throughout the year. That was the largest decline. And it finished up, what, 19. So this year we've seen a 10% decline, and it's up 2. I think it actually, as of today, maybe it's up 7. So this is much more normal. We're going to, as we see volatility, we expect this. This is planned when we built your portfolios. So we're not going to go derail our whole investment plan because we see some volatility. Again, when we build that, we plan on this happening, and we take advantage of it when we see it.
So I was talking with someone earlier this week in the office, and they're like, well, yeah, this makes some sense. I mean, last year was a big year, and I mean, of course, stocks are not going to go anywhere as long as we have this trade war starting. I mean, I'm sure that's the main reason that stocks haven't gone anywhere this year. And so I started thinking about that, and I'm like, well, yeah, there's the trade war, but then there's like interest rates are increasing, and unemployment is very, very, very low, which means that labor costs are going up, which, where's my neighbor, Roberta? As Roberta instructed me yesterday, the price of things are going up. We have, maybe some inflation fears. And then there's retail sales, and there's home sales, and so there's a myriad of things that can affect the markets, right? And so who knows really what the catalyst was to cause where we are year to date. But if we really think through that, how much of that can we control? You know what I'm saying? And so, yeah, I think part of our job is to really pay attention to everything that's going on in the world. But I think the biggest part of our job, or where we think we should spend most of our time, is on the things that are really important and that really make a difference for our clients. Things like, have we developed a solid financial plan that's going to make sure that you got the cash flow to do what you want to do for the rest of your life without ever running out of money? Is that supported by an investment strategy that's not based on just the latest hot thing or what we read in Money Magazine or Motley Fool or whatever, but it's based on decades of financial science or rigorous peer-reviewed academic research that really document how capital markets really work? And it's based on maybe helping you minimize your expenses, including minimizing your taxes. And maybe if you're charitably inclined, saying, hey, well, rather than giving cash to the church or to your favorite charity, I mean, if you're over 70.5, give away your minimum required distribution. I mean, that's the way you need to do it. Quit taking, just because you've had your tithe coming out of your checking account for the past 20 years, stop that, because it's a lot more effective or give away stocks where you got big built-in capital gains and give that to the church, because the church doesn't pay tax on the capital gains. Or maybe taking a look at your beneficiary designations and make sure those are up to date, or that your will and your trust are up to date. And the key people that need to get to those estate planning documents can get to them in the hour of need. And so, we really feel like those are the things that we ought to be focusing on and making sure we get those things right. And that's how maybe we can add the most value to you guys. And I think that really that's what some of the things that Scott's going to talk about is, how do we be smarter investors, and what are some of the danger areas that we can avoid. So I am just so glad that Scott's here. Scott has an MBA from Yale University. He was a teaching assistant with Ken French, and I don't know if you know who Ken French is, but he's one of the world-renowned finance professors that, together with Gene Fama, has pretty much shaped modern portfolio theory the way it's practiced. And so I am just so delighted to have Scott here today with us. So, Scott?
Thank you, Ron. All right, so I'm going to talk for maybe 30 or 40 minutes. I'm going to leave this little clock right here so I don't run into the wee hours of the night, have the bar close on all of you, and you really hate me at that point. So, Brian said more than one occasion this was going to be kind of fun and a little bit casual, and I hope it is entertaining as well. I do work for Dimensional. I've worked for Dimensional for 22 years, right out of grad school in 1996. But I'm not really going to talk at all about Dimensional. But I will at least offer you the opportunity to ask me questions about Dimensional when we're done with this. This presentation is all about you. And when I mean you, what I mean is human beings. So that would actually include me and Dennis and Brian. Sometimes we may seem like we're robots, but in fact, we have all the same issues and all the same biases and all the same psychological baggage that everybody else has. Just because we're investment professionals doesn't mean we've learned to somehow cure ourselves of these biases, and that's going to be a recurring theme. So I want to start by kind of opening this with three main points, and those points are: we, collectively, we do not like to be wrong, we do not like to lose, and we do not like to get hurt. And everything else I say for the next 30 or 40 minutes is basically going to reinforce those three things. And so why is that important? Well, let's start. I said this would be fun, but I'm going to start with a quiz. I know you weren't expecting to be tested today, but let's try this out for a second. Now, this is actually a fairly famous psychology experiment that two fellows, one named Daniel Kahneman, the other named Amos Tversky. They were professors of psychology. They were trained in Israel. They moved to the United States earlier in their careers, mostly taught in the West Coast, Berkeley, Stanford, the University of Vancouver. And one of the things they started to do was they started to rethink kind of the idea that all of us are kind of computers, right? We're always making decisions based on our rational self-interest, because they observed themselves and people around them not actually applying that. And the typical psychology rebuttal was, well, it doesn't really matter, it all comes out in the wash. So in other words, we on average act really rational, but you'll see anomalies. And what they found was that wasn't the case at all. And so they started devising experiments. One of the most famous is this one. So imagine you're graduate students at one of those universities, and you've been probably paid something like $5 to come in and fill out answer a series of questions. One of them is this question about Linda. So let me first set this up. You're going to be asked to make a decision about Linda in a second, but you have to know who Linda is first. So Linda's 31 years old. She's single, outspoken, very bright. She majored in philosophy. As a student, she was deeply concerned with issues of discrimination and social justice, and also participated in anti-nuclear demonstrations. Well, we don't have a lot of those anymore, but this was written in the 1960s and 70s, so you can understand the context a little bit. So the question is the following: which is more probable, Linda's a bank teller or Linda's a bank teller who is active in the feminist movement? So this is an actual quiz. Hands up for those who like one, sorry. Who likes 2? Right, okay, that's how it's supposed to work. Right, so everybody saw, if you're in the front row, you might not have noticed, literally 95% of the room wants 2, and there was a hand up over here for 1. And what do you know about this question?
I don't know a thing about the question, but I think she's bypassed. If she's working and she's a bank teller for sure, she's probably bypassed all that. She's seen the real world, not the real world through, let's say, an unreal spotlight. For instance, she was in the university, or she got a different concept. She's past that box.
Okay, what's your name?
John. That's a 4-letter word.
Thank you, John. So that's interesting. That's really interesting, because that's not what I thought you were going to say. So you kind of applied. I gave you some information about Linda, and what did you do? You added more, which is really interesting. I think if I were actually a psychologist, I might want to actually see you after class. because I might want to devise a whole new experiment here. But did anybody else pick one? Anybody else in the room pick one?
I did.
You did? Okay. I'll ask both of you. Why'd you pick one?
Because she's just a bank teller. I figured, she had some issues with discrimination, but it didn't say that she was really, feminist.
Okay. Okay. So you're not, okay, I'm going to hold that for a second. One more.
It just seems like statistically more likely that she belongs.
There it is. There it is. That's the one. So what's your name? Trent. So what Trent just said is, he just kind of looked at this and said, one is more statistically likely than two. Like, duh. And now forget the description for a second. Just read the answers to 1 and 2. And is Trent right?
Yes.
Does the answer to this question have to be 1 in all circumstances?
No.
You're still shaking your head no. Here's what's going on in your minds and in mine. It's called intuition. And what's happening is intuition in this case, there's a little bit of a battle going on, whether you know it or not, between the logic part of the way you think and the intuitive part of the way you think. And the intuitive part of the way you think is completely overwhelming the logic part, except for Trent. Because even you two that picked 1, I don't know that you picked it for the reasons that the psychologist would say. You were aware of this thing called a conjunction fallacy, right? What's the conjunction fallacy? Kahneman and Tversky coined the term the conjunction fallacy to explain their observations with this test. Now, don't feel bad, right? Because they would give this test to students, graduate students, in the psychology departments at these universities, and they made the same error. Now, other psychologists would argue this isn't really an error, and you would, I think, mostly agree with this, meaning, well, it's not an error because you've tricked us, right? You've given us this information about Linda, right? And then you asked us to make a probability discussion. Well, they would argue, why give us the information about Linda if I didn't need it to make the decision? But to Kahneman and Tversky, and for my purposes, that's the real key here, right? So how much information do you get on a daily basis that is leading you to make certain decisions, sometimes about your money or your investments? And now think, how much of that information is actually of any use at all to make the right kind of decision? That's the lesson of this, is not to try to teach you to become antisocial and only think statistically. You would be a really boring person. We all need to use intuition. Intuition is really, really useful. It just so happens that in certain cases, when uncertainty is high, when money's involved, intuition can lead us astray. So that's the Linda experiment, and that's the first of a couple of quizzes I'll share with you today. Yeah, question.
Okay, she does all those things. The next thing she's going to do is move into the feminist movement.
Say it again.
Can you refute that?
So so let's just say this is true about Linda.
Yeah.
Now, it would be a different question and a very difficult, if I just said, what's more likely, she's a bank teller or she's active in the feminist movement? If that's all I said, so the second one, right? I mean, I maybe didn't fully, I think, just to clear this up, this is 2 is a subset of 1, right? Every single bank teller in 1, only some of them are going to be active in the feminist movement. So you're requiring Linda to be both of these things, and here you're only requiring her to be 1. So that's why, just statistically speaking, bank teller is more likely. Now, if what you're saying is, which is more likely, she's a bank teller or she's a bank teller who's active in the she's just in the feminist movement, whatever that means. I don't know if you have an official enrollment to be in the feminist movement, or you simply say, I'm in the feminist movement.
And that's one of the issues I have with your statement, with your second statement.
Which second?
Linda is a bank teller and active in the feminist movement. Define active in the feminist movement.
I don't need to. Well, and I don't need to because it doesn't matter how I define this. I can define it really broadly or really narrowly. It's going to be a smaller As long as there's one bank teller who's has nothing to do with it, as long as there's at least one, there's more people here than there is here. Now, but you brought up a great point about what if it's not a conjunction? What if I didn't put this as a conjunction question? What if I just said bank teller and feminist movement? Which one's more likely? Now you've got to actually employ something else, which is, do you have any idea which population is bigger? Like, I don't know, take a wild guess. How many bank tellers are there in the world? I don't know, right? 100,000. How many people are active in the feminist movement or would identify as such? Well, I don't know the answers to those questions, but what I'm getting at as a psychologist would say, you have to basically have some understanding of base rates. So here's a different experiment. Another one that they've done, right? It's similar to the Linda experiment, but it doesn't necessarily draw out the conjunction. What it does is it describes a guy named Tom. And they talk, I don't remember the word for word description, but Tom is basically described as outdoorsy, loves to camp and fish, wears cowboy boots, rides horses, makes his own furniture. So that's Tom. And then you're asked, similar, which alternative is more probable? Tom is a lawyer or Tom is a cowboy? Now, which one are you going to pick? Cowboy, of course, right? Right? And again, that's not a conjunction fallacy because lawyers and cowboys have nothing to do with each other. And I didn't make one a subset of the other. But here's where base rates come in. How many lawyers are there in the United States? Ba-dum-bum. How many lawyers are there in this room? Right? Hey, this is going really well. Let's keep the bar open. All right. How many cowboys do you think there are? Like legit, I'm a cowboy. I make money as a cowboy. I don't know, several thousand, maybe? Like, I don't know. But my intuition would tell me that the base rate for lawyers is probably, 100 times the base rate for cowboys. And yet my intuition wants me to make Tom a cowboy because he sounds like a cowboy. But it's far more likely Tom's a lawyer, right, who just likes the outdoors. Maybe he's a lawyer in Colorado, but the odds of him being a cowboy are low because the base rates are low. That's a whole different psychological bias. The conjunction fallacy is one. Ignoring base rates is a whole nother one. But that's not as easy to describe to an audience like this. So I usually don't spend 30 minutes on Linda, but you guys really like this. I seem to have struck a chord with Linda here. Okay, so I'm going to talk a little bit about behavioral psychology. That was where I got that Linda experiment was, as I said, from Kahneman and Tversky. The very first paper they wrote was this paper called Judgment Under Uncertainty, Heuristics and Biases. So kind of a mouthful, but it's a really fun paper to read. It was published in 1974, and it really was the article that started everything. And it talked about people rely on these limited number of heuristic principles, something they coined the term. It's what we call today mental biases, mental shortcuts, which reduce the complex tasks of assessing probabilities and predicting values to simple judgmental operations. So we use these shortcuts to simplify our life. In general, they are quite useful, but sometimes they lead to severe and systematic errors. And I want to pause on that for a second just to highlight this. So we know what severe means, right? These can be catastrophically bad decisions if we don't do them right. What systematic means, at least in the case of this context, is that we don't learn from we learn from some of our mistakes, but we don't learn from all of our mistakes. Some of them are just hardwired. And I know psychologists don't like the wiring term, but they're baked into the way our psychology works. Mine as well as yours. It's not something you can cure. It's only something you can get good at being aware of when it's happening. Harder than it sounds. So, another quiz. This is, they organize these into 3 categories, and I'll explain each one of them. All the biases, and I'll outline a few of them in a second, either had to do something with this idea of anchoring and adjusting, or it had to do with availability, or it had to do with representativeness. And so you don't have to write that down. I'll explain what all that means in a second. So here's another quick quiz, right? Hopefully nobody in here is an expert on the heights of redwood trees. But this is a simple, like, yes, no, binary question. It's either, your guess is either going to be higher or lower. And that's fine, it's just a guess, right? If you're wrong, I don't have any expectations that you understand how tall redwood trees are. So think of an answer. Which do you think it is? And then I want you to think about an answer to the second question, which is, okay, rather than be so broad, let's be specific. What do you think is the average, or excuse me, the height of the tallest redwood tree? So did anybody think of a number? You didn't play along, did you? Did you think of a number?
500 feet.
500 feet, 1,000 feet, okay. Now imagine if you could erase the last 30 seconds from your memories, and instead of showing you this slide, I showed you this one. And the first question changes. Instead of asking you if it's higher or lower than 1,200 feet, I'm now asking you if it's higher or lower than 180 feet. For most of you, your answer to that first question would be different, right? Now, think about the answer to the second question. First of all, should that answer be different? It's the same question. Will it be different? Almost certainly. And so when they do this experiment, what they find is that when they have the high anchor cohorts, their answer to the second question is significantly higher than the low anchor cohorts. Now, in this case, the two questions are both about redwood trees, but I didn't have to do that. So in a fun experiment, they do something similar where they'll have some sort of hey, please estimate the number of fill in the blank. One of the most often used ones for whatever reason is how many countries are in the United Nations from the continent of Africa. But what they would do before that is they would ask you a question like this. Think of the last 3 digits of your social security number. Or think of the last 3 digits of your phone number. Or think of the last 3 digits of your house number. Whatever. It's some random number, but for which the population is going to have very different results. And then they ask you to guess a numerical question. And your numerical question, even though the questions are unrelated to each other, is anchored to that first number. As soon as I make you think of a number, you can't get it out of your head. And again, it's just another example of how easily we can be influenced, we can be primed in how we make decisions around what are seemingly pretty easy questions. Now this one gets a little trickier. Let's imagine I actually had a flip chart up here and I had a coin. And I was going to flip it right in front of you, and someone would be up here making sure I wasn't cheating. And I'd write down 6 flips in a row, right? Every time I flip the coin, I'm going to write down either heads or tails. And I'm going to do it 6 times consecutively. Which do you think would be a more likely outcome? A, B, or C? Can you all see this? Heads, tails, tails, heads. That's the sequence A. Sequence B, 3 heads followed by 3 tails. Sequence C is 5 heads with a tail at the 5th sequence. Anybody who wants A? Who wants B? Who wants C? Who knows the answer? Does anybody know which one it is? So everybody, again, overwhelmingly A. This is working perfectly for my purposes. Overwhelmingly, you all wanted A. Why? Well, I'll give you a hint. It's representative of what we would expect to see if I was flipping a fair coin. Now here's the actual answer, which I only know this because I looked it up. There are 64 possible sequences, everything from all heads to all tails, and then everything in between, right? And each of them is equally likely. So the odds of any one sequence showing up is 1 over 64. Now, remember, I'm tricking you a little bit here because you're coming into this thinking a fair coin should be 50-50. So a 50-50 outcome should be more likely than 100% zero. And you would be right. 50-50, there's way more combinations of those 64 that have 3 heads and 3 tails in them. But I asked for a specific sequence, and the sequences are unique and discrete, right? There's only one sequence that looks like this. And that's where the kind of the logic gets a little bit shouted out by the intuition of representativeness. Now, here's the second part of this, which I made up myself. I didn't even have to use Kahneman and Tversky's help for this. Let's imagine that I actually did that in front of you on my little flip chart, and the sequence that I put up was actually C. You watched me flip C. And then I went through the whole rigmarole of how this is, one of 64 sequences, and I said, but we're going to do one more thing before I move on to the next slide. I'm going to flip the coin a 7th time, but before I do, I want you to guess. Is it going to be heads or tails? Who wants heads? A few hands went up for heads. Who wants tails? No one's, you guys are all on to me now. You're like, okay, this is, I can't win, right? Because it's going to be none of the above, right? Sort of. Okay, for those that wanted heads, why do you want heads? Well, okay, so here's, right? So this is one where logic and intuition are kind of, you're listening to both of them. What do you know about a fair coin? What do you know intrinsically about a fair coin? It's 50-50 every time, right? But what is the intuition part of your brain also whispering? There's a lot more heads here. So there's two possible intuitive answers. One is, well, I'm going to play momentum here. Heads is on a roll, and I'll just play heads until that momentum runs out. The other one is the much more common one, which is I'm going to bet tails. Why? It's due, right? Tails is due. Like there's been this long run of heads, and so what your intuition is thinking that as I flip more, I'm going to get a reversion to the mean, right? The mean is 50-50, and I should see a reversion to that mean. But that flies in the face of what we also know about a fair coin, right? Can a fair coin revert to the mean? Because the fair coin doesn't remember what the last flip was, right? So it's still 50-50, and you know that, but you want to bet something. Now, where does this show up in real life? I heard it twice, casinos. Where specifically in the casino does this show up? Roulette table, right? Why? So for those of you that don't go to Vegas or aren't familiar with casinos, roulette tables, it's a wheel with a ball, right? And you place your bets on the felt, and there's 38 possible bets, right? There's numbers 1 through 36, plus there's 2 zeros. So it's like a coin with 38 sides, and it's completely fair, well, we hope. Now, what Vegas and other casinos have discovered is they want to tell you what the last 20 results have been on this wheel. So when you go to the table to bet, you're going to see this electronic board, and it's going to show you the last 20 spins. Now, what do you know about the usefulness of that information?
It's not useful.
There is no usefulness, exactly. You know that. But what does Vegas find when they have roulette wheels that have that board and they have roulette wheels that don't have the board? What do you think happens? Odds are exactly the same, but they get way more activity when they provide you useless information, which you know is useless. Right, so this is really, we can laugh, right? We can laugh, but this is for real. Like, we are so easily manipulated. And I'm not saying you are, I'm saying I am. I'm saying we are. We are so easily manipulated by people giving us information. And as soon as they do that, they know what's going to happen. They know that your intuition is going to click on automatically. And there's no way for you to avoid it. You can remember, oh wait, I know about this intuition thing, and I'm hearing it, but I'm also hearing from the logic side. And if you understand the situations to tune this one out and let this one dominate your decision making, you're in good shape. Now, if you wake up in the middle of the night and you smell smoke, what does your intuition tell you? Listen to your intuition, right? So there's lots of really good reasons why we listen to intuition in all walks of life. So do not for a minute think that thinking that Linda should be a bank teller and active in the feminist movement, and really even after this presentation is over and you're leaving and you're driving home and you're looking at your spouse and I know she's in the feminist movement. I just know it. That's okay. That's intuition doing its job. Just know that that's what's happening. All right. There's a lot more in this, and I don't want to take up too much time. We're at 4:50 right now, so I've got maybe 15 or 20 minutes left. But so there's a whole library catalog of biases that we could talk about. These are just 6. They're fairly big ones. And I'll just go through these really briefly to understand these are the things at play in all of our heads. One is overconfidence. This is a really good one to have, right? And you want to have some of it. Some people have lots of it. But basically, it affords us a way to feel better about ourselves. It affords us a way to take some risks that we might not ever take, or step out, or get out of our comfort zone, or innovate and invent iPhones and all sorts of stuff that ruin our lives when we think they're better. But overconfidence really does drive a lot of creativity. So that's not something that you would want to somehow take a pill and immunize yourself against. The problem, of course, is, as Charlie Munger once said in a Berkshire Hathaway shareholders meeting, it's the strong swimmers who drown.
Yes, it is.
Right?
That's right.
Pam says, yes, it is. Pam's my mom's name, so
Oh, well, good.
we're already bonding up here. What do I mean by that? Pam's nodding. Why is she nodding?
Underconfident ones aren't swimming.
They're confident. They're good swimmers. They're going to take more risk. They're not even going to think it's risk because they're such strong swimmers. And then all of a sudden, something bad might happen, right? And if you know you're not a strong swimmer, you're not going to take those risks, or you're much less likely to put yourself in situations. Investing works the same way. Warren Buffett, Charlie Munger's partner at Berkshire, says the dumb money, we like this term smart money and dumb money. He says the dumb money ceases to be dumb only when it recognizes it's dumb. Meaning that as soon as you know you don't know enough to outperform the market, pick stocks, time markets, then you're going to invest normally. And you're going to know you don't know that stuff, and you're going to have a much better investment experience. So that's overconfidence. Illusion of control is another mechanism that we have in place to remember I said we don't like to be hurt, right? We don't like to be wrong. We don't like to lose, and we don't like to be hurt. An illusion of control is one of these psychological defenses that we all deploy in a variety of ways to make us feel a little bit safer. The way this can manifest itself in investing is, well, I'm not going to invest in anything I don't understand. Well, there's about 12,000 securities in your portfolio on the equity side if you're invested with these fellas. I'm roughly guessing here. At least more than 10,000. Try to understand all 10,000 of those stocks, right? Try to have an illusion of control that you know something about all those companies. So what does that applied to investing do? It severely limits your ability to diversify globally. If you're only going to invest in, well, I like Starbucks coffee, there's one company. I'm on Facebook all the time. That didn't work out too well today, but I'm in that company. And then the list goes on and on. But you get to 50 or 60 stocks, and your brain is full, right? So this idea that you can control the outcome of your portfolio by knowing what the companies are doing is completely ludicrous. Regret avoidance is one of these things where we do learn from some of our mistakes. The problem is we don't see it as a bad decision. We see the outcome, right? So for example, maybe you were invested in the markets back in 2000, 01, and 02, and maybe you were heavily invested in technology companies. And you might say today, as an investor, I'm fully diversified except for the tech sector. I hate those things. I'm never going to buy those again because they burned me last time. Well, that's blaming an outcome. The decision to invest in technology stocks, that's part of a globally diversified portfolio. Now, the decision to overweight them, as many did, that was a bad decision, turned out. But it shouldn't affect the way you invest going forward. You should learn from that lesson, but don't learn the wrong lesson. Hindsight bias, this just makes us think, what just happened should have been really easy to predict. So therefore, what's going to happen next? I'm going to try to predict that because the past looks so easy. Why does the past look so easy to predict? Well, it's partly illusion of control. So illusion of control kicks in and says, oh, here's why that happened. you know, here's why so-and-so got elected. Here's why the market did this. Here's why this, and so, you know, the housing crisis was full of this hindsight bias. We all saw this coming. It all should have been avoidable. But everything looks like that in hindsight. But it gives us this false sense of security that the future is easy to predict. Confirmation bias is a lot of fun. This is one where you either watch Fox News or MSNBC. You don't watch both. You know what I'm getting at? Right? So without making a political statement, very few people watch both. Now, on election night I did, and that was super fun to watch that on election night. That was like, it was like watching a tennis match between two legends. But what do I mean by that? Like, if you've got some pretty strong opinions and beliefs, you're going to seek out other people that have those same beliefs. Now, I'm not suggesting, I mean, I have gotten really good at seeking out the opinions of people who don't agree with me, and I highly recommend it. It grounds you, it gets you out of that echo chamber. It doesn't change my perspective, to be honest, but it does make me a little bit more sympathetic for the opinions of others. But I don't want to get into a social experiment here. Let's just move on to the last one, which is attribution bias. So before I get into that, I'm going to share a story with you that really highlights some of these and really draws an underline under attribution bias. And that is, so here's a graph of an investment that happened about 300 years ago by a fellow named Sir Isaac Newton. Now, Newton was a very smart individual, and he was a pretty savvy investor. And this was one of his holdings in his portfolio called the South Sea Company. And for those of you that are history buffs, you might have heard about the bubble era of the early 1700s. This was not the only stock subject to that bubble era, but it was one that I think has been highly researched and discussed, specifically around Newton's participation in it. So really smart guy, really well connected. So let me give you a little bit of context here. So this is, you can't possibly read this from anywhere but the front row. This is early in 1720. And you see how benign this stock looks. It's clipping coupons at about 5 or 6% a year. They didn't really have coupons, but they did pay interest. And then kind of out of nowhere, this stock shoots up about 2.5 times. Right? So he had been an investor, actually, this yellow dot says he invested here. He actually invested well before then. This is a graphic I borrowed from Mark Faber and Jeremy Grantham. So he was an investor way back early in the 1713, 1714 era. Just minding his own business, had about 5,000 pounds in this one particular, which was a lot of money back then. And then boom, out of nowhere, the stock, which had done nothing since its IPO 7 or 8 years earlier, shoots up 2.5, 3 times, and he gets out. Now, before I advance the slide, let's just imagine for a second that the stock maybe kind of jumps around here, but basically at some point, not too short after he sells, it comes back down to earth and continues to behave as it was behaving before. How do you think he feels about this decision to sell? Really happy, like, right? Like, I recognized something irrational was happening. There was no economic basis for this sudden rise in stock price, so I recognized that. I cashed out, and boy, aren't I happy. About 20,000 pounds is what he made on this. Plus his original investment, that's 25,000 pounds. So, but that's not what happened. The stock goes straight up. It starts to accelerate even more. And as Faber sort of, I'm sure he's like tongue-in-cheeking here, but it's, you know, Newton's friends are getting rich. He's at, you know, the controller's office or the Mint or Oxford, wherever he was working at the time. And Newton was kind of a recluse. I don't know how many friends he actually had, but the ones he did have were like, hey, Newt, you got out too early. You know, you got to wait for the fever to break, whatever like isms of the time were popular. So this is really difficult for Newton. And so what is he feeling now? He's feeling some regret, right? He's feeling like, what, man, I have left so much money on the table. So what do you think he might do here? Get back in, right? He actually does. He gets back in. He gets back in with everything that he originally sold out of. He's also managing other people's money at this point in time. At least one other family was part of these trades. So he gets back in. Go ahead. Re-enters with a lot. You know the graph doesn't go much higher than this because you can see my axis over there. So go ahead and forward on. So that's what happens, and this is actual price movement of the South Sea stock. And it did eventually start behaving, and this stock goes on, this stock continued on for another 150 years before it finally, went the way of the dinosaur. But Newton basically lost the whole kettle of fish in this one trade. And what he said was, and this is where attribution bias comes in, go ahead and advance the slide. I can calculate the motion of heavenly bodies, but not the madness of people. So that first part of that statement, which he's attributed with saying this, not after he lost all his money, but before he got back in. So between those two, between the profit sale and then getting back in. And basically what he's saying here is, in case you don't know who I am, I'm really smart. That's the first part of that sentence. And the second part of that sentence is, and nobody else is. Like everybody else in this market is a complete idiot. I don't know what happened, but I blame them, right? Not me. That's attribution bias, right? When we make a decision that turns out well, we often attribute that to our own intelligence, skill, foresight. When we make decisions that turn out poorly, we usually try to blame at least some of it on externalities. In this case, maybe all of it on externalities. The brains of humans and other animals contain a mechanism that is designed to give priority to bad news. This is super important to remember. And remember my opening remarks, we don't like to lose, we don't like to be wrong, and we don't like to get hurt. I could have actually said, we like to win, we like to be right, and we like to feel good. But I didn't, because I know, because of all the stuff I've read, that you're much more likely to tune in to bad news or to bad feelings than you are to tune into good feelings. That's just how it works, right? And it's a survival instinct. It actually makes perfect sense. You wouldn't want to change this. Because if you were, back in, let's go back a long time, caveman days, if you're faced with a predator, the last thing you want to do is take a long time to decide, what to do next, right? You want to make really quick decisions, and there's a pot of gold over here, but there's a lion guarding, that sort of thing, right? The lion is going to focus, you're going to focus all your attention on the lion, not the pot of gold sitting next to it. And that's just how it works. Go ahead and click that. So the media knows this. Go ahead and animate through this. You got all kinds of negatives. You got a few positives. I love these two. Go ahead, one more. So, there's a lot of gloom and there's a lot of doom because that's what we pay attention to. That big red Time magazine said the crash. That was from 1987, right? I mean, the S&P 500 in 1987 returned about 5.5%, 6%. But right in the middle of that, 1987, was a massive 22% drop in a single day. But we forget about it quickly, right? But they don't want you to. They want you to remember those bad things. Now, the other thing I'll mention is these two Money Magazine articles that are on the top. One of them is from 1997, and one of them is from 1999. Here's what I find really fascinating, is this one is from 1999, and it seems to be a positive cover, right? Handsome couple. The word rich is on there. The green of the lawn is probably no coincidence to the green of money. And they're smiling, they look really happy. But what's the undertone to this cover story? It's easy, I like that one. They're making it seem like, but what is the undertone? The undertone is like, if you're not getting rich, and I'm guessing you're not, because you might have read our article from 2 years ago that told you to sell everything. But if you forget about that, don't worry about it, because if you're not getting rich, open this magazine and we'll teach you how to be just like this really handsome couple on the cover. So even this positive cover has this negative undertone that's triggering the greed and envy that we all have. And that's just natural. All right, let's click that again. Did it work? Okay, there's the Kramer effect. This is let's file this one under not all information is useful information. But it doesn't mean it's not entertaining, and it doesn't mean that people aren't going to tune in. But this show is kind of interesting from psychology. Of course, it's from a psychological perspective, in that psychology experts cite this show as basically designed in a way. If you were a psychologist and someone said, hey, design a program that's just going to make people anxious and want to call their brokers, this is how you would design it. You would have one person, not many. You wouldn't have competing opinions. You'd have one very strong person. You'd have lots of distractions, lights and sounds, and you'd have a ton of information too. You don't want to drip it on them. You want to just fire hose it on them. All these things, go ahead and click through that, and it kind of highlights these. The most important one being this concept that the psychologists call a halo effect. And the halo effect is one where if this person seems really knowledgeable and I don't hear anybody dissenting. Does anybody watch this show or has ever watched this show? I have. It's okay to admit it. Do you hear the people that call in? Did they ever say like, no, Jim, that's wrong? Because here's the right answer to that. Do you ever hear that on this show? No. Everybody that calls in basically kisses his shoes first. Like, Jim, first time caller, long time viewer. Just love you. Just love everything about you. Love your tie today. Whatever. It's all about like, just putting him on a pedestal. And there's no dissenting opinion. So nothing he says is ever countered. Which, this is interesting, I thought, in articles that have come out about this show, is this was a complete mold breaker for cable news television. Because up to this point, everything on cable news, and a lot of programming on cable news is still this way, is what? A debate, right? It's people yelling at each other from different sides of the aisle or from different opinions. As a matter of fact, the show he was on before this was called Kudlow and Kramer, because they like to debate stuff about the stock market and stuff about the economy. And that seemed to be the winning formula. And then all of a sudden this thing hits the airs and it blows everything else out of the water. People cannot turn this show off because of all of the distractions and all of the information they're getting. They just didn't know that it wasn't useful. All right, click through that one more time. And so you can believe that for me, but I love the fact that even the industry itself helps us out on this point, which is Steve Forbes, publisher of Forbes magazine. You make more money selling advice than following it. It's one of the things we count on in the magazine business. And if that wasn't good enough, he also adds, along with the short memory of our readers. So think back to those 2 Money magazine articles. What they're hoping is that you don't call them out on the fact that they were the ones that told you to sell your stock in 1987, and that's why you're not getting rich in 1999. All right, so I want to say a quick, this is the only kind of like pointy-headed stuff I'll get into here from the economics faculty at the University of Chicago. This is Gene Fama, who's kind of known as the rational markets guy, right? The markets work guy, the market efficiency hypothesis, if you've heard of that. And he talks about the market efficiency because a lot of people attack it and they say, when we get bubbles and crashes and all this volatility, clearly that means markets are broken. And he says, no, the market efficiency model will say that when people's attitude for risk changes, prices will change very quickly, and that's volatility, right? But he also admits, he's like, look, it's just a model. If it were perfect, we wouldn't call it a model, right? We'd call it reality. But he says, but it's a good model to help you build portfolios. And the finance people say the same thing. Basically, they say, no, the markets are broken and there's all these anomalies we can see after the fact. And even some of them you can see these price discrepancies, these irrationalities, if you will, in real time. It's not always easy to profit from them, but they admit, go ahead and click to Thaler. So Thaler's the other guy at the University of Chicago. He's the guy that came up with the whole behavioral finance side of the economics and investment field. And while most people acknowledge the fact that the efficient market hypothesis isn't perfect, behavioral finance is really interesting, and it's the new kid on the block, they both come to the same conclusion, though, which is the right way to invest is to likely say, I don't know what the markets are going to do, so I'm just going to diversify, and in the case of Align, tilt towards higher expected returns. Use the information and prices to help you build portfolios. The analogy I'll give you, which has helped me and has helped some of my audiences, is this idea of like, don't think of these 2 competing theories as competing theories. Use them both when you think about your own investment portfolio. And here's what I mean. One of them, genes, tells you how to build the portfolio. So imagine we talk about investment journeys all the time, right? You're all on an investment journey, different parts of it, but it's essentially getting from point A, which is where you are today, to point B, some point in the future. And so for that journey, you need a car. We'll just use a car as our analogy. So what efficient markets helps you do is it helps you build the car. It helps you build the car, the tires, the transmission, the interior, the engine, the gas mileage, everything. That's efficient markets. Behavioral finance tells you how to drive the car. And think about a journey. You have to do both of those right to get to point B. So they're both really useful. They're not trying to compete with each other, at least for your purposes. Now, Gene and Dick are academics, right? They're both really wealthy people. They don't need to worry about building the right car. And frankly, they can build them any way they want. They're not going to do that badly. But they can debate over these pointy-headed subjects about which model's better. For you, as investors, and for me as an investor, I'm much better off focusing on what matters to me. What are the implications for my journey to point B? All right, so let's wrap this up. I've got a few. So this is really important. It's easier to recognize. I said this earlier. I'll say it again. This is from Kahneman. By the way, this book, if you want a deeper dive into the subject matter, Kahneman really unpacks the whole, from the 1960s with he and Tversky to way before them, up until present day. Thinking Fast and Slow, really dense read. So fair warning, it's not nearly as fun as some might think, like a Michael Lewis book might be. It's easier to recognize other people's mistakes than our own. Click again. The best we can do is this compromise. Right? We're not going to shut it off. That's the compromise. But we are going to have a plan with our advisor to recognize situations where mistakes are likely and avoid those when these stakes are high. And what do we got left here? And just remember, right? I love this slide. It's a great one to kind of wrap up on. Is that even if you know the markets here are irrational, right? Even if you know the price of something is wrong, right? And then you place a bet, you place a trade that takes advantage of that thing that's wrong. Well, who's to say it's not just going to get more wrong before it actually gets right? Right? So the problem with that is that you might lose all your money in pursuit of that right price before it ever gets right. And what Gene likes to say is, once you lose all your money, there's no coming back from that. Right? You can lose half your money, like many of us did in our equity portfolios in 2007 through early 2009. I mean, equities were down 50% globally. But 50% is not 100%. And in 50% you can come back from. 100%, there's no coming back from that. So remember that, and I think I've got one last slide to just kind of wrap all this stuff. So go ahead and click through this. This is just telling you what I've already told you, which is also known as a summary in some presentations. This is important. So, and I didn't say this maybe demonstrably enough in the beginning. These things are not irrational or abnormal. It is perfectly rational and perfectly normal for you to want, down to your tippy toes, for Linda to be active in the feminist movement. That is normal. It's not irrational. So when intuition kicks in and when you want to sell stocks because the sky appears to be falling, that is not irrational behavior. It's not irrational thoughts. Actually, making the trades is a mistake. And we can outline all the reasons for that. But thinking that you need to make a trade is not a mistake. Okay, so that's that first point. Second point, these are permanent, difficult to recognize in ourselves. Third point, efficient markets, behavioral finance are not in competition, at least for your purposes or mine. They're complementary to having a successful investment experience. And this last one, framing can greatly influence our ability to recognize situations that require logic over intuition. That's really key, especially if you consume any type of financial news media in any form. Just remember, information is really good and it makes you informed. You can talk at cocktail parties about what's going on in Russia and what's going on in Europe, and wow, that dollar is really doing crazy things, isn't it? Yeah, that dollar, wow, what about that market, right? But you don't want to use that information to make investment decisions because all that information is already in the market prices. So I'll stop there. Happy to take questions. I've heard the bar is still open, so that might give a second thought there on questions. But yeah, I would love to take questions. But before I turn it over, thank you so much for your attention. Thank you so much for being good sports and your participation. I always love to talk to the end clients. I talk a lot to investment professionals, and that can be kind of dry and boring. It's always fun to talk to the people that are actually using our funds, and for that, I really do thank you. So thank you for your time tonight.
Yeah, I'll just wrap it up with the obvious that I guess to get a job at Dimensional Fund Advisors, you've got to be like a human specimen. You've got to like dress right, look right, and be off the charts smart.
All right, well, I'll take that as a compliment.
You should. Yeah, so I mean, I think a lot of these points really drove home a lot of the things that we think about at Align, and that is the longer that, not to date myself, but this is my 26th year, and it's like the more that I know, the less I understand, and I think that's valuable actually, because I think hubris can be one of the most dangerous things, and one of the quickest ways you can lose a lot of money in markets is to confuse skill with luck. And so we never forget that we don't have the right to gamble with anyone's money in this room. That's why we base all of our decisions on all these mountains of academic research. It's out there. Anyone who wants to go do this can go down to the Edmond Library and find all these papers that Scott was talking about. But what we're about is helping you get your financial goals and never run out of money and sustain your lifestyle. That's what we're about. We're not about getting you the highest return, whatever that is, or maximizing your return, whatever in the heck that is. It's all about helping you get your cash flow needs met without any real concern of running out of money. And I hope that you will feel free to call us anytime. And that's what we're here for. Sit down and say, hey, what's going on? It looks weird to me. How am I doing with my plan? Is my plan going to be sustainable? So anyway, any questions from anybody, or should we head that way and maybe grab a drink or whatever? Anybody? Any questions at all? Thank you guys for being here. I know everybody's got a busy schedule. Thank you guys so much. Appreciate you guys so much.